The first time the currency fell, it didn't feel like a crisis. It felt like a notification. A grocery receipt that was a little longer than usual. A fuel price sign that changed twice in 1 week. A streaming subscription that quietly updated its pricing for your region. No sirens. No bank run. Just the same life, priced differently. And then, months later, the currency stopped falling. The headlines relaxed. The central bank held a press conference. Traders moved on. People expected relief. But the prices didn't come back down. The milk stayed expensive. The bus fare didn't reverse. The restaurant menu didn't normalize. Even when the exchange rate stabilized, the cost of living stayed stuck at a higher floor. That's the trap. Not inflation that's ragging. Inflation that's locked in. And the uncomfortable question is, if inflation was caused by a weaker currency, why doesn't a stronger currency undo it? Why don't prices rewind the way they fast-forwarded? Because a currency drop doesn't just change numbers on a screen. It changes behavior. It changes contracts. It changes wages. It changes expectations. And once those things move, the economy doesn't glide back. It ratchets. Let's make it simple. Imagine a small country that imports most of what it consumes: energy, fertilizer, medicine, spare parts, electronics. The local currency is the lira. Most international invoices are priced in dollars or euros. When the lira weakens, every imported thing becomes more expensive overnight in local terms. Not because the foreign seller got greedier, because the same dollar price now costs more lira. So the fuel distributor raises fuel prices. Then the trucking company raises transport prices. Then the supermarket raises food prices. Then the restaurant raises menu prices. Then workers ask for higher wages because groceries and rent are higher. Then the service businesses, who don't import anything, raise prices too, because their biggest input is labor. This is what people picture. Currency down, imports up, prices up. And the story people tell themselves is the reverse. Currency stops falling, imports stop rising, prices should come down. But that story assumes prices behave like a spring. In reality, prices behave like a staircase. They go up quickly. They come down slowly. Sometimes they don't come down at all. And the reasons are not mysterious. They're structural. They're boring, which is what makes them dangerous. Start with the most basic, almost embarrassing truth. Most businesses do not update prices in real time. They're not robots. They're people. Changing prices has costs. Printing menus, updating systems, retagging shelves, renegotiating with distributors, explaining it to customers, training staff to answer, why is this different? Economists call this menu costs. But it's not just menus. It's friction. So when costs rise, businesses move fast because they're afraid of bleeding cash. When costs fall, they hesitate because a lower price is hard to take back. It's easier to keep the new price and wait. That alone creates stickiness. But stickiness is just the surface. The deeper mechanism is replacement cost. A store doesn't price goods based on what it paid last month. It prices goods based on what it will cost to replace them next month. If the currency weakened recently, even if it stabilized today, the next shipment is still priced at the new exchange rate. Sometimes worse, because suppliers add buffers when volatility rises. And even when the currency strengthens a bit, importers and retailers remember what volatility did to them. They start buying insurance. Not literal insurance. Economic insurance. They hold more inventory. They hedge currency risk. They demand bigger margins. They build a safety cushion into prices. That cushion doesn't disappear just because the exchange rate prints a nicer number this week. This is the first part of the stuck inflation trap. After a currency shock, businesses start pricing for uncertainty, not for today's spot rate. Now comes the second part, wages. When prices jump, People don't just complain. They adapt. They ask for raises. Unions negotiate. Employers offer cost of living adjustments. Governments raise minimum wages. Public sector pay gets revised. Contractors rewrite terms. At first, those wage changes look like a response to inflation. But then they become a driver of inflation. Because wages are different from fuel. Fuel can fall tomorrow. Wages don't. Wages are downward sticky. Not because people are irrational, but because wage cuts are socially explosive, legally constrained, and operationally risky. Try telling a workforce, good news, the currency stabilized. So we're reducing your salary back to last year's level. You won't get stability. You'll get resignations, strikes, lawsuits, a collapse in morale. So once wages move up, they tend to stay up. And in a service-heavy economy, wages are the price. Haircuts, childcare, repairs, restaurants, health services, education, security, cleaning, call centers, logistics. Even if imported goods stop rising, wages keep the overall price level elevated. That's the second part of the trap. The currency shock migrates from tradable goods into domestic services through wages, and services don't import deflation easily. Now the third part, expectations. This one is subtle, and it's where inflation becomes psychological without becoming imaginary. In stable economies, people expect tomorrow to look roughly like today. They plan, sign contracts, and set prices with that assumption. After a currency shock, the default assumption flips. People stop expecting stability. A landlord thinks, if the currency weakens again, I don't want to be stuck with a low rent. So they raise rent now, or they add indexation clauses. A supplier thinks, if inputs spike again, I don't want to renegotiate every month. So they quote higher, and they shorten payment terms. A contractor thinks, if costs jump mid-project, I lose money. So they build contingencies into bids. A worker thinks, I'd rather lock in a raise now than hope prices calm down. A consumer thinks, buy now before it gets worse. Everyone is doing something that makes sense individually. Together, it makes inflation persistent. Because once you embed inflation into behavior, contracts, clauses, frequency of price updates, then inflation doesn't need a new shock to continue. It has inertia. And that's why the currency can stabilize and prices can remain stuck. The economy has already rewritten the rules it lives by. Now let's address the hype versus reality moment. Because this is where public narratives get dangerous. The hype is, if we just stabilize the currency, inflation will fix itself. Or, if the currency rebounds, prices will come back down. That belief shows up everywhere. In political speeches, in social media, in dinner table arguments. It sounds intuitive, fair, and comforting. Reality is harsher. Currency stabilization is necessary, but it's rarely sufficient. Because the currency is the trigger, not the entire machine. The machine is passed through wages, expectations, market structure, and policy credibility. And the machine doesn't reverse on command. Let's talk about pass-through for a second, but in plain language. When the currency weakens, import costs go up. Some of that is passed to consumers. How much depends on competition and margins. In highly competitive markets, businesses may absorb some of the shock to keep customers. In concentrated markets, they don't have to. They pass through more, faster. After the shock, something else happens. The market often becomes less competitive. Smaller businesses that can't finance inventory or hedge currency risk get squeezed out. They fail. They merge. They stop importing. They reduce variety. The survivors gain pricing power. So when the currency later improves a bit, the competitive pressure that would have forced prices down is weaker than before. That's the fourth part of the trap. Currency shocks can reduce competition, making high prices sticky because fewer players need to fight for market share. And then there's debt. In many countries, businesses and governments borrow in foreign currency. Dollars, euros, yen. When the local currency weakens, that debt burden explodes in local terms. So companies suddenly need more local currency cash flow to service the same foreign debt. They raise prices. They cut costs. They lay off staff. Governments face the same problem. Foreign debt service becomes more expensive, budgets tighten, and politically easy options appear. One of those options is to tolerate higher inflation because inflation reduces the real value of domestic debts and raises nominal tax revenues. Even without a conspiracy, the incentives tilt. And if the public senses that incentives tilt, expectations shift again. Now add one more ingredient: fiscal policy and subsidies. When a currency shock hits, governments often respond by subsidizing fuel, food, or electricity to prevent social unrest. That can temporarily suppress visible inflation. But subsidies are expensive, and currency weakness makes them even more expensive. Eventually, the government reduces subsidies or removes them. Prices jump again. People lose trust. Businesses build bigger buffers. Inflation gets more stuck. So the trap isn't just economic. It's political. And that's why you can see a country where the exchange rate looks better on the chart while the cost of living feels permanently worse in real life. Now zoom out. Because the bigger risk isn't that prices stay high. The bigger risk is what people do when they accept that prices only go one way. If households believe the currency will eventually weaken again, they stop saving in the local currency. They move into dollars, gold, real estate, inventory, anything that feels real. That behavior weakens the local currency further because demand for foreign currency rises. If businesses believe costs will keep rising, they shorten contracts and demand faster payment. That reduces credit and slows investment. If workers believe purchasing power will erode, they demand higher wages more frequently. That pushes service inflation. If the central bank tries to fight inflation with higher interest rates, it can slow demand. But it can also raise the government's debt service costs, which can force more borrowing, which can pressure the currency again. This is where stuck inflation becomes a self-reinforcing loop. Not because anyone is evil, because the system is cornered. And in that corner, policymakers face trade-offs that don't look like the headlines. Raise rates hard enough to crush demand, and you can slow inflation. But you may trigger a recession, bankrupt leveraged firms, and worsen fiscal stress. Defend the currency with reserves, and you can buy time. But reserves are finite, and markets can smell panic. Control prices, and you can delay pain. But shortages and black markets appear, and the real price shows up somewhere else. Print money to cover deficits, and you can keep the lights on, but you validate the inflation expectations you were trying to kill. So what actually brings prices back down? Sometimes, nothing does, at least not in nominal terms. What often happens is quieter. Prices stop rising as fast. Wages catch up slowly. People adjust. Inflation falls. But the price level doesn't rewind. The economy lives on a new plateau. That's why people say, inflation is down, but everything is still expensive. They're not confused. They're describing levels versus rates. Inflation is the speed. The price level is the distance you've already traveled. A weaker currency can accelerate the speed. But once you've traveled that distance, once contracts, wages, and expectations have moved, you don't teleport backward. In rare cases, prices do fall. But that usually comes with something else. A deep recession that crushes demand, or a powerful productivity boom, or a dramatic strengthening of the currency combined with restored competition. And those are not gentle solutions. They are costly, slow, or both. So if you're watching a currency stabilize and wondering why your groceries don't get cheaper, the honest answer is because the currency shock didn't just change import prices. It taught the whole economy to behave differently. It taught businesses to price for volatility. It taught workers to demand protection. It taught consumers to buy ahead. It taught landlords and suppliers to index. And once an economy learns that lesson, unlearning it takes more than a better exchange rate. It takes trust. Trust that the currency will hold. Trust that policy will be consistent. Trust that contracts don't need emergency clauses. Trust that price cuts won't be punished later by the next spike. Trust is a financial variable, even if it never appears on the screen. And here's the uncomfortable ending, because this is where the premium explainer truth usually lands. A country can stabilize its currency and still live with the consequences of a past devaluation for years. Not because the market is broken, because the market remembered. So the real question isn't, when will prices come back down? The real question is, what would it take for an entire economy to believe, again, that tomorrow won't be worse than today?